Hello, everyone. Today on the final bar, we're going to talk about the market continuing to push higher, although the S&P sort of finishing flat for the day, sort of chopping around a little bit going into the close. But that pattern that we saw last week with and then I feel like for many weeks up until this one with tech-led Nasdaq up pretty well, the S&P sort of flat and small and mid caps down continues again today. So the breadth doesn't look that attractive, but the market continues to push higher. Ladies and gentlemen, this is the final bar. Hello, everyone. Dave Keller here with StockCharts.com. Welcome to the final bar. Very happy to have you join us every weekday after the close to break down the market's activity from a technical, behavioral perspective, trying to make sense of the patterns that we see, and most importantly, connecting the short term of today with the long term over time. As I mentioned in the introduction, it's interesting, and I thought about it again as I was going through the S&P 500 charts over the weekend. When you're going through consumer discretionary and some of the other communication services, for example, you have these big mega cap charts, just resilient, super strong uptrends. Amazon may be the best example of that. But then when you get further down, there are a lot of sort of mediocre to questionable charts out there. But the S&P, the broad measures of market health continue to be positive. So you have this situation where the breadth doesn't look as attractive. You have mid and small caps not confirming the uptrend, feeling weaker. So the playbook, the traditional playbook from what I learned, years and years ago, that I continue to follow, says that's classic topping pattern right there. When you have a small, narrow number of names leading higher. But again, we've had that signal, that combination for a little while now, and the market continues higher. So I think at this point, we're going to talk as we go through the three phases: top down, rotation, sectors, and then stock picking, just how to think about those and what that might mean for us. I did want to point out some of the guests we have coming up. We had some fantastic guests on the show last week. I felt this week is going to be fantastic. Tomorrow, Tuesday, we have Joe Rabel from Rabel Stock Research joining us for the first time. On Wednesday, Dave Landry, and I asked Dave if he could switch to this week. So sorry, we sort of talked about him last Thursday. I ended up taking a vacation with the family, so appreciate him being flexible joining us on Wednesday. And then on Thursday, Mark Young from WallStreetSentiment.com. Thursday is a big sentiment day, so I asked Mark if he'd join the show and give his take on the latest numbers coming out related to sentiment. As a reminder, on September 22nd, our event called Introducing Stock Charts ACP. We're super excited to talk through some of the features of ACP, including Chip Anderson, Grayson Rose, and I from the Stock Charts team, but also a lot of fantastic guests, John Murphy, Ralph Acampora, many others, to help us understand how technical analysis is evolving and how StockCharts ACP hopefully will help you get your head around this market activity. Let's get to our market recap. As I mentioned, we've had this situation, this condition, this phenomenon of the market rallying on weaker breadth and without confirmation from mid caps and small caps. If you ask me, can the market rally without the participation of all of those things, without confirmation from breadth and from mid and small caps? I'd say you can, but for a limited amount of time. That's pretty classic topping pattern is you get the market continuing higher. Sort of think mid to late 2007, if you remember that. Big blue chip names like Pepsi go higher and peak out at the end of 2007, while earlier in the year you had a lot of mid and small cap names actually topping out. The Russell 2000, if I remember right, as well. So the last thing to roll over is the broad index. That's kind of the classic pattern. What we're seeing here, though, is a relatively small number of mega cap names that are literally able to hold the market up. And so the weakening breadth, the lack of participation it seems at this point, it's less predictive. It feels more descriptive. It's less prescribing that the market's topping out because of the lack of participation from these other points. It's more describing this is how the market's continuing to go higher. over time, I think in the end, I think we'll be validated by seeing a market pullback, and I think you'll see a breather taken by by everything as we process all these gains we've had. The S&P now at 3,500 after blowing right through 3,400 there not too long ago. But again, from a timing perspective, I think when you see those conditions, it more describes what's happening. The charts themselves, the indications of breakdowns through support and elsewhere is where I think you want to be looking for to validate potential downside for stocks. We've not seen it yet. Let's look at a chart of the S&P 500. Then I want to go through some of the other indications that we've seen here. So here's the chart of the S&P as I talked about. We hit 3,400 here in mid-August. We then rallied higher, and you can see the S&P just around 3,500. I didn't refresh that right into the close, but there you see it. What's interesting is if you look at the RSI, which is at the bottom there, you can see that it was extremely overbought, or if not extremely overbought, really, really close. And that's what happens when you have an RSI above 80, right? So what we've talked about is in a strong uptrend and in an extended uptrend, you will see a market become extremely overbought, which means it's seen such strong momentum, you will most likely see another push higher once you alleviate that overbought condition. And so the base case that I think we're seeing, at this point, I'd have to see is we're well overdue for a pullback of substance to process all these recent gains. I wouldn't be surprised now. Maybe we move it higher. My base case was a move back to 3,200 to 3,250, sort of this purple shaded area. We seem to have blown right past 3,400. So I think we go back down to this area. 3,400 would be the first objective. I still think a move down to 3,200, 3,250 would be ideal if you're long-term bullish, because you want to digest those gains. You want enough of a pullback that it's not completely unreasonable for us to have a new leg higher with a new influx of buying power and so forth. But at this point, the trend remains in a significant uptrend by any measure. Let's look at some of the other quick updates here. And as I mentioned, we're going to start with the macro perspective here. We'll talk about sectors and talk about individual stocks here in a little bit. So I don't want to belabor sectors and other stocks, but just keeping it at a high level. As I mentioned, lack of confirmation today from mid and small caps. Small caps actually finished below 900 on the S&P 600 index and closed at the lows of the day. Bonds actually did better today, rallying really in the morning session. Came off a little bit in the afternoon, but still up a little bit. That pushed 10-year yields down a little bit. Gold and silver continuing to do pretty well, although the rest of the commodities sort of flat for a little bit. I just want to jump to the chart of gold. The GLD is a chart that we've talked about where it's been in a pretty strong uptrend. It has this pattern of extreme overbought conditions, alleviating those, and then resuming this uptrend. And I think what was most interesting recently is the GLD pulling back around 38.2%, right around to $180 a share. If you're eyeing a trend line using the peak from early August, the peak to mid-August, and where we're just breaking above that trend line resistance today, if not Friday. So sort of rotating potentially back to the upside. Again, I think 180 is a decent support level, a decent floor to be paying attention to. Also note the 50-day moving average that's just below those levels as well. RSI remaining above 50, which is overall in a pretty bullish configuration. Just to very quickly finish off this macro discussion, I wanted to point out the dollar. So we're going to look a little later at U.S. stocks versus non-U.S. stocks, because the U.S. has been outperforming, and again, it's driven by the mega cap stocks in the U.S. for sure. But that phenomenon with the market rallying in the U.S. and the U.S. outperforming global stocks, we usually expect that to be driven by a stronger dollar. And I think one of the challenges we saw recently over the last, looking at June and July, you had this breakdown of the dollar breaking down through support, the U.S. dollar index going to a new, 2-year low now. And so you're looking at this thinking, all right, weaker dollar, that has to mean non-U.S. stocks certainly emerging in a position of strength, but you actually don't have that right now. You have a weaker dollar, but you have stronger U.S. versus non-U.S. stocks. We're going to talk about that a little bit more later, but I think that's a key theme. And I think the concern there, I guess the cautionary tale, and I know this from reading John Murphy's book, from books on intermarket analysis, from talking with John, from talking with many others that really focus on intermarket relationships. Bob Prechter comes to mind. I think when we oversimplify and think US dollar going down means US stocks should outperform, or the stocks going up, which means gold should be going down because it's a safe haven, people don't need it. For every example of where that particular narrative plays out, I will show you a different example where it does not play out. So here we have a situation where the dollar is weakening and US stocks are outperforming non-US stocks. It can happen. We're seeing it right now. So the cautionary tale, the comment, the takeaway from that is, don't think about what should happen based on traditional relationships. Focus on what is happening. And again, I think that's where the benefits of charting and visualizing the evolution of these trends will keep you on the right side of things, as opposed to guessing what should work based on some macro thesis or big picture idea. Our next segment, sector setups. Let's talk about the 11 S&P sectors, how they're rotating around the S&P 500. Just going to refresh this a little bit. This is the most recent cut using the weekly data. I usually look at the last 5 weeks on here just to show how the longer term trends are evolving. Again, if you want to do a more thorough analysis, the daily RRG, the daily relative rotation graph, can also give you more of the tactical read on positions, people rotating in or out of sectors, or overweights and underweights on that short-term tactical time frame. Here we're looking a little more longer term. So some key themes to pay attention to as we, again, the idea is sectors are rotating around the S&P. My first takeaway is that rotation is kind of broken, though. If you think about this like a clock and you assume that things are going to rotate very neatly around the benchmark in the middle, I think what we've seen recently is that is not always the case. And I know this, having followed this methodology for many years and working with Julius de Kempener on, how he thinks of it, how he created it, and how he's used it. It's oversimplifying market rotations to think that they just neatly rotate around the 0 point in the middle. And as an example of that is industrials, right? Industrials kind of rotated up here. They rotated back. We're heading sort of due south, which suggests, basically the momentum is coming off, even though it's still underperforming. But you can see it's now taking a big left turn. It's almost heading due east. So it's kind of broken this rotation. It's been rotating on its own, sort of in the improving quadrant up here. Same with technology. Technology had been improving, now sort of taking a detour southwest, lightening up a little bit. And again, since it's further right, means it's outperforming, but it's not just following this big rotation around the x-axis. You can see similar things with healthcare, which started to improve and now took a big left turn. You can see this with energy, which basically did a big 360 way over here on the lagging, or the far left side of the scatter plot. So overall, I would say if you just are expecting everything to neatly rotate around the middle, it's not going to happen. I think we're seeing some of those situations now, to be honest with you, as I think different sectors, different stocks are dealing with this market conditions and sort of evolving in very different ways. The overall takeaway from an investment perspective: technology number one, consumer discretionary number two, and then I would say third, it's maybe tied between materials and communication services. And the only reason I say that is because materials is rotating down, communication services rotating back up. They're both pretty much even because furthest to the right means they're outperforming. So they're pretty consistent in terms of in a similar relative place. But in terms of the momentum, certainly seems to be favoring communication services in the short term. Healthcare is an interesting one. We talk about biotechs, and I think, the chart of Regeneron maybe is a good one. It's right at that point where you see it breaking down to new swing lows, or holding up and getting the new influx of buyers that pushes the price to, retest the highs or potentially go to new highs. I think with biotech as a group, they're sort of on breakdown watch, while other things were holding up okay, and on a relative basis, certainly getting hurt. So I'm not surprised to see healthcare kind of rotating over here to the left. There are plenty of opportunities within healthcare, I think, if you're looking at individual groups or stocks, but as a sector, as a broad overweight, pharma, biotech sort of weighing pretty heavy on there. Interesting from an idea perspective are things like financials and industrials sort of in the improving quadrant and rotating back to more of a constructive direction. That might be some places to look for some opportunities. Let's zoom out a bit and look at the 11 S&P sectors using the candle glance function. And again, just some broad takeaways as I was reviewing these going into preparing for the show today. I think you can bucket these based on certain patterns, right? There are the up and to the right, long and strong, things are good. And again, not based on a relative perspective, but just based on the price patterns. Communication services, consumer discretionary, consumer staples. technology would be the and materials honestly would be the five that I would put in there. How I might have done six, I forget already, but 4 to 6, whatever I just said, those are the group that are in a pretty decent shape. Higher highs, higher lows. The primary trend seems positive above upward sloping moving averages. That's kind of the the default uptrend. You then have the have-nots, the very weaker position sectors, and at this point, it's only a couple. Energy has been the standard, the standby one that's been consistently underperforming below 2 downward sloping moving averages. Utilities really, really close to that, sort of right at its 50-day moving average, but has been unable to break above moving average resistance and previous price resistance, and the relative strength has been absolutely horrible for utilities since the March low, really. Then you have the others, right? The things that are sort of in the middle in a rotation. Industrials is an interesting sector because it broke above resistance, then sort of, you sort of saw a resistance on the XLI around 76, broke back above that the first week in August, pulled back, retested that resistance level at 76, and now testing a new swing high, down a bit today off of a peak just below 79, but overall very constructive, higher highs and higher lows. And again, the trend there seems relatively positive. Financials are a tough one. It's sort of between the two moving averages right now. And again, this sector, I think, has really struggled to emerge while other sectors have been able to eclipse their June highs. Financials have not. When they've been able to break above their 200-day moving average, financials have not. They're sort of stuck in this middle range. And until it breaks above really 26 on the XLF and then a follow through above 2650, which would push it above the June highs, I think you have to hold off on thinking of this as too much of a broader overweight, especially with relative strength testing new 52 plus week lows there. The final sector I just want to talk about very quickly is healthcare, right? So healthcare is one that on a relative basis, you can see the relative strength has been down. This is healthcare relative to technology, just showing how one sector has clearly been underperforming the other, and that's a longer term trend going back to the market low in December of 2018. But from a pure price perspective, it's making a new closing high this week after making a new closing high last week. Pretty constructive. It's just the problem is it's not able to match the relative strength in some of those other sectors like tech, like consumer discretionary, like communication services. So healthcare is one of those with a good price chart, but an underwhelming relative chart. And as a result, I think overall you have to avoid a place like that until you see improvement down here. The money is made on the relative line. Let's take a quick commercial break. We'll be back with shifting stocks. We'll see you in a minute. Hey everyone, welcome back. This is Dave Keller at StockCharts.com here in Redmond, Washington. Thanks for joining us every weekday after the close for the final bar. As a reminder, we'd love to answer your questions on the air. We have a mailbag segment coming up tomorrow on Tuesday's show, and again, another one at the end of the week. Shoot us any questions you have about charting, about technical indicators, about particular tickers or visualizations, ways you're trying to look at things. Nothing is out of bounds for us. Shoot us an email, thefinalbar@stockcharts.com, or just tag us on Twitter @finalbarsctv. We'd love to answer one of your questions next time on the air. Our final segment today is called Shifting Stocks. We've now talked about the broad market environment, and again, this condition where you have a small number of sectors and a small number of stocks within those sectors really driving prices higher, even though breadth has not been confirming over the last couple weeks, and today is sort of more of the same here, with the NASDAQ leading with small and mid caps lagging, the S&P sort of stuck in the middle, holding its gains recently okay. From a sector perspective, you have, again, a limited number of sectors: tech, consumers, discretionary, communication services, arguably industrials in very good places. And you have others like healthcare and others that they're struggling. Financials, another one, really not able to perform on a relative basis, even though the prices are holding up okay. And certainly in limited parts of each of those sectors. Now let's look at some individual stocks. And part of my routine over the weekend is to go through the S&P 500 chart by chart, sort of make some notes every week about what I'm seeing and how it's evolved. I want to focus a little bit on consumer, and we'll try to do both consumer discretionary and consumer staples with the time we have here. And I just want to highlight some of the key charts to pay attention to. I'll try to get through as many of these as I can. When we think about the overall market environment and we think about the S&P going higher, it's charts like this. When you go through the S&P 500, you hit on Amazon, you see this beautiful uptrend. And what I try to do, it's beautiful that the ticker is way over here on the left, because what I do as I'm going through these charts is I'm focusing over here on the right side. I'm just looking at the patterns. When I see something that's interesting, like a chart going to new highs above two upward sloping moving averages, not overbought, relative strength threatening a new 12-month high, I'm thinking, wow, it's a great chart. Obviously, it's Amazon. I kind of know that just from knowing we're in consumer and it's a chart going up and to the right. I can guess that's what it is. But it's a reminder that the charts that look like this are those big mega cap names. Those are the really impressive charts out there. There are random ones lower in the cap tiers for sure, but in terms of what really impresses me going through this exercise, it's charts like, it's big names like Amazon, like Apple, and others. So I'm not surprised that the market's holding up, even though from an equal weighted perspective, as we're going to look at in a little later, it's not as attractive as you might assume. So let's go through some of these very quickly. I just want to point out when you get to home builders, and sorry, I meant to bring up like Lennar, right? And when you look at some of the home builders, what's interesting when you look at consumer discretionary, you have a basket of stocks that are in uptrends, but just pulling back a little bit. The last week was a little weaker. And again, while the primary trend is still very much positive, stocks like Lennar and the other home builders sort of fit into this as well. The auto parts makers come in here as well. So if you look at AAP, if you look at AZO, they all kind of have the similar pattern where they're in an uptrend, higher highs, higher lows. They've pulled back a little bit. Most of those that I mentioned, not to their 50-day moving average yet. It's more just sort of pulling back. But what it makes me think is if the market's sort of continuing its next leg higher, these are stocks, unlike things like Apple, which are sort of going vertical, Tesla and others. These are ones that are pulling back a little bit. These are sort of the buyable charts, long-term uptrend, weaker in the last week or two. And it suggests, again, opportunistically, that's more of the ideal chart to buy into. It's not something going vertical where you might just buy at the high and top tick the chart. These are more where you're able to accumulate at a better tactical position. So it strikes me that a lot of consumer discretionary looks kind of like that. I also wanted to point out there's some charts that are just breaking above their 200-day moving average or threatening to do so. And MGM is probably a really good example of that, down over 5% today. And it's interesting that happened as it tested, had the June high here, just around $24, came back, retested that same level here first week in August, came off, once again trying to break above 24. And Friday certainly looked like it was closing, and that's when I review this. I'm thinking, boy, this might be it. This is the new closing high. It's closing at 24. That's a nice breakout. Today we're right back down, coming off of the overbought condition. So charts like MGM might be really interesting to see right now if it's able to follow through above there or not. I wouldn't be surprised if you get a little more of a pullback off of resistance here. Hilton is another one, just breaking above its 200-day moving average last week after threatening to do so for a while. Now unable to get above its June peak just yet. But again, overall, above its 200-day, I have to appreciate that. And you want to see if it's able to hold that, both of those charts on any sort of pullback. LYV is another one. This is Live Nation, looks similar to the previous two charts. This one breaking above its 200-day moving average, overbought while doing so. And that was the warning flag in my mind. I'm thinking, boy, it's trying to break out, but it's overbought at the moment, and it's not above its June high yet. So within consumer, I think you have to watch for some of those stocks that are threatening to break out, but just not able to get above those previous highs. And if and when they do, I think that could give you more confidence of further upside. So on something like LYV, I think you look for a break above 60 to believe in the potential for further upside. Just within consumer discretionary, I'd point out Starbucks is one chart that looks pretty decent. This just broke above its June high. I mentioned with the previous basket stocks that had not been able to do so, Starbucks actually has. So you have this this challenge where it's breaking to new swing highs. It's overbought, which means up a lot. That's good. The question is, on any sort of pullback, is it able to maintain higher highs, higher lows? On this one, you certainly want to see it remain above its 200-day moving average. And booking BKNG is the other one I would point out, kind of similar to the Starbucks chart, just finally breaking above its June peak. And again, with those charts, you'd want to see if they when they pull back off of an overbought condition, which is totally reasonable, they continue to make a higher low, and that might be a really good opportunistic point there. Finally, I would point out Royal Caribbean, which is not quite above its 200-day moving average. So compared to the other ones, it's not above its 200-day, not above the June highs. It's overbought, so it's sort of hitting resistance and not yet able to eclipse that. So until it's able to get above sort of that 75 level, which would be a new swing high above the moving averages, then I'd feel pretty good about it. Now, also, I would point out something like eBay is sort of on breakdown watch. It's holding its support from late July, early August, and now broke back below its 50-day moving average, which isn't the end of the world, but I'd want to see if it's able to hold that around 53, 53.50. If it breaks down there, I think you have to be a little more concerned about potential for further downside. Very quickly going through some charts within consumer staples, you have a different group of couple different buckets I'll highlight. The first group are stocks that are in uptrends and pulling back right about to an ascending 50-day moving average, RSI remaining in a bullish configuration. It might be a really good opportunistic pullback. Hormel HRL is one of those. Clorox is the second one, CLX. CLX actually broke just below its 50-day, but really, really close. And so I was wanting to see if it was able to hold that or not. That's why I think with that one, what I was looking for is, does it follow through on that breakdown below the swing low from August? The challenge with a lot of the staples charts, the relative strength has not been as good because, again, these are pulling back when a lot of other sectors are doing well. The second bucket are things that have pulled back and are now starting to appreciate out of the pullback. Kellogg is one, and look at how the RSI never really got below 50 on that recent pullback. I think that's a really good setup right here. Kraft Heinz KHC is another one, sort of pulling back, making a higher low, which is good to see. And then KMB, Kimberly-Clark will be the third, maybe a little earlier, but I like the pullback to 155, the swing low from August. And then finally, within consumer, I just wanted to point out SJM. This is one that gapped higher and now really testing the swing high here from April. So if it's able to to sort of come off of this overbought condition, rotate higher, get above 124, that would take it above the swing high from April. I think that has potential for further upside there as well. So within consumer, some interesting charts at fairly actionable levels. The ones I gave you, I think, are ones with some key levels or key signals to be watching for. And again, potential for confirmation for further upside with a number of those charts. We need to wrap the show, go right to the 3 and 3 charts in 3 minutes. Here we go. Chart number one is looking at the U.S. versus the world. Earlier, I talked about, this condition with the weaker dollar, but U.S. stocks outperforming. And this is what the relative chart looks like. If you look at the S&P versus ACWI, which is all country world. And I'm often asked, should I use versus ACWI or versus ACWX, which is all country ex-US? Either one, I think the ratio looks pretty similar. It's just the way how you're handling the denominator. So I'm not that concerned about the differences, but I am pointing out the relative performance has certainly been favoring, by any measure, U.S. over non-U.S., and that's been happening since really mid to late August. So, it's threatening to make a new high for 2020, and this is in the face of a weaker dollar, which is fairly unusual. When you look at the broad markets, the U.S. And EFA and EM and frontier markets, and you start the clock at that June peak. So in black, we have the S&P 500. You can see it sold off from the peak the second week in June, finally broke above there in mid-July, and overall about 8.5% higher than that June peak. EM is now right about the same. So while EM sort of jumped out early in late June, early July, it's now come back, and EM and U.S. stocks are about similar, up about 8.5% to 9% since the June peak. The reason why that chart of relative performance of U.S. versus non-U.S. is going up is because this developed non-U.S. stocks only up 6%, which is still impressive, but not nearly as good as the U.S. market. And that's why it's favoring U.S. over non-U.S. Sorry. This is frontier markets here. I was going to say it didn't make sense as I was saying. EFA's down here, only up 2%, while the S&P is up 8.5%. And that's why that ratio is rotating downward, or rotating upward, favoring the U.S. Finally, I just want to point out, I've talked about this theme in our macro portion of the day, talking about leadership, narrow leadership, and lack of confirmation in terms of breadth. And this is one way we can look at it. The ratio of the equal weighted S&P versus the cap weighted S&P threatening to make a new 12-month low and breaking below the low from mid-May. That's sort of confirmed. That would be the nail in the coffin, apparently, for the weakness in the mega cap trade. It's certainly been dominating. It's certainly pushing the market higher. Until that market turns up, I think you still have to be leaning into those mega cap names any way that you can. Folks, that's our show for today. Thank you so much for joining us. Good to have you here every weekday for the final bar. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.